Good morning and welcome to this Tuesday, August 8th edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes as we prepare for the trading day ahead. Well, right now we do have futures that are down again. Dow futures are down 248 points. S&P 500 futures down about 31. NASDAQ futures about 105. So it does look like the market will get off to a little bit of a rough start this morning. Again, it is during this period where, I think the market I know historically, the market does not perform very well. And we'll see what happens this year. But, the market had a huge run up in 2023 and coming off the October 2022 low, actually. And I just think it's normal to see this period of consolidation. I do think fourth quarter is going to be very strong, but what we do from here till there is a little bit more up in the air just because of history, the seasonality. We know August and September, not very strong. I did a little research over the weekend, and I think of the last 73 years on the S&P 500, the months of August and September have both gone higher a total of 16 times out of 73 years. And I'm not talking about, going up 5% or 10%. I'm talking about if they've just gone up. If August ends the month higher than it began and September ends the month higher than it began, then it would qualify if both those months happened. And it's only happened 16 times in 73 years. So we know that there are some obstacles anytime we face this time of the year. And I think that's partly what's going on here. I think that's playing out a little bit. It didn't help that we had overbought conditions. It didn't help that in mid-July, we had a ton of in-the-money call premium. Really, that's kind of what triggered everything. The market started to struggle at that point. We really haven't kind of gotten our feet under us since. There have been some good days, there have been some bad days, but overall, the market has struggled since mid-July. And historically, that's kind of a normal thing. That's what we expect. That's what we normally see. Not a whole lot of economic news coming out this week. Earnings news, still plenty of that, but it is slowing. Last week was our heaviest week of the quarter. So we will start to see the earnings slow down. I know we've still got a couple of big reports. Applied Materials will be out later this week. That's in that important semiconductor group. And Applied Materials competitors, Lam Research and KLA Corp, both had excellent reports. Both continue to perform pretty well. And Applied Materials not far from a 52-week high as we approach its earnings later this week. So I suspect that once we get toward the end of the week, and I'm going to say this maybe with a little caveat because I think it's really important that the CPI and the PPI, which come out Thursday and Friday mornings, they need to be somewhat tame. I think with the fear we have with interest rates, I think if we get a hotter number than expected and rates jump again, that could continue to spook the market, at least at the opening bell. And I've got some interesting charts I'll show you in a bit. But let's go ahead and start with the recap from yesterday. So the Dow Jones Industrial Average rose 407 points yesterday. That was up more than 1%. S&P 500 up 40. That was 0.9% gain. NASDAQ 100 up also about 0.9%, gaining 133 points. Mid caps were up 0.8%, jumping 21. And the small cap index, S&P 600 small cap index, up almost 0.6%, up 7 points. Looking at the AD lines, I think the Dow looks pretty good. S&P and NASDAQ both dropping a little bit with price action, but nothing horrible. I suspect we're going to see those bounce right back as well. Mid caps looking strong, small caps really looking good. And transports rising another 0.5% yesterday. Look at the AD line there. Transports continuing to trade off of its 20-day moving average. Do have a negative divergence here on this one. We've seen what's happened with the NASDAQ. We've been battling a negative divergence really since mid-July. And a lot of things, came up in mid-July that triggered some of this weakness and consolidation. One was a negative divergence. One was short-term, the options world just getting a little bit too bullish. We saw the 5-day moving average of the equity-only put-call ratio move to a 52-week low. So, and I think also the VIX and the S&P 500 started to move kind of in, positive correlation with one another, which is very unusual. And that normally suggests that a potential reversal is at hand. So I think all of that combined is helping, or I don't know if helping is the right word, but causing the market to struggle a little bit here in the near term. I haven't changed my forecast at all. I think an interesting day will be coming today on the IWM, because that is the other ETF, the other small cap ETF. It did not fare as well as the S&P 600 small cap index. In fact, I think the IWM finished pretty flat on the day yesterday, but it did bounce back after moving below its 20-day moving average, which was good. But small caps are looking to gap down at the open this morning, potentially below the 20-day. So today's going to be a big day, I think, for at least the IWM, that portion of small caps. But we'll look at that in just a bit. As far as the sectors go, communication services, financials, and real estate, those were your three leaders. Kind of a mixed bag. You got a really aggressive area, the XLC, communication services. You got financials, which I consider an aggressive group, but it's also made up of a lot of value stocks. And it normally goes along with the S&P 500. It normally is not normally it's not going to carry the S&P by itself, and it normally isn't going to lag, too far behind the S&P. That's kind of throughout the history of secular bull markets. But yesterday it did lead. So it was good to see, because financials, as you can see, have been trending higher. They moved down to challenge their 20-day moving average, and they're bouncing off of it. So I find all of that to be pretty bullish for that group. Real estate, a defensive group. So we had an aggressive group, a really aggressive group, a somewhat aggressive group, kind of mixed in with some value, and then a defensive group leading the market to the upside yesterday. Go figure. As far as the industry groups go, reinsurance in that financial space, up 3.5%. Really strong day, and you can see clear breakout continuing there on that group. Recreational services, which has been one of the leading groups probably over the last 3 months or so, has been pulling back. Yesterday, though, jumped again, 3.3%. This could be, we had a negative divergence. We went down almost to that 50-day moving average. This could be where we bounce and start to make another run in this group. And that too is in the, consumer discretionary group, along with travel and tourism, which was up 2.77%. I'll also give a shout out to the internet group. I think they were up around 2.25%. So all in all, not a bad day. I did see a little bit more rotation toward the value versus growth. That's why we saw the Dow lead. That's why we saw the S&P also outperforming the NASDAQ. That's why we saw the financials and real estate up at the top. So clearly we're seeing a little bit more rotation toward the value. And that kind of makes sense when the market struggles for a period of time, because usually when the market's going up, it's led by aggressive groups. When it pulls back, a lot of times it pulls back because of profit taking in those aggressive groups. And that's what we've been seeing. 10-year Treasury yield. Let's get the latest there. It is down another, let's see, what is that? 7 basis points, 4.01%. So that big reversal, that bearish engulfing candle that we saw here on the 10-year Treasury yield that occurred back on Friday of last week, that has continued. We continue to move lower. I would not be surprised to see this go back down, not only to the 50, but maybe even back down to 370. I think a lot of it's going to depend on those 2 inflation reports that come out Thursday and Friday morning. Again, the CPI will be out Thursday at 8:30 in the morning, and the PPI will be out Friday, 8:30 in the morning. If those come in, and both are expected to come in, by the way, rising 0.2%, both at the headline and core levels. If you multiply those times 12, that's 2.4%. I mean, we're starting to get to the point where these inflation reports are starting to point back toward that 2% target area. Fed's not there yet. Fed keeps talking tough. Fed may raise again. They're still saying that they're undecided. We'll see what happens next month or later this month. But the CPI and the PPI report will be big, I think, later this week for a number of reasons, some of which I just talked about. Let's pull up the S&P 500. You can see the S&P 500 pulled back, consolidated. Really, since we got into option expiration week, right around in here, it was a very labored attempt to move higher. And you can see as we did so, PPO was just starting to roll over slightly. So we had that slight negative divergence. Then we went down below the 20-day, bounced back yesterday above the 20-day. Futures now look like they're going to take us back down below the 20-day. We had a double top on the S&P 500 around 44.50. So that would seem like a short-term support area. If we do fully reset that PPO back down near the center line, we could see a 50-day test on the S&P, and that would be down just above 4,400. Looking at the NASDAQ 100, a little bit more weakness here, and you can see that top much more clearly from that would have been July 19th. So 2 days before options expired, we saw the selling into options, saw a little bit of a recovery, couldn't get back through the high, and now we put in a little low. Personally, I mean, I'm not a huge Elliott wave person. This would probably really, it's outside of my area of expertise. But these types of pullbacks where you have an A, B, slight rise, but not moving to a new high, and then C, ABC, these are very typical in a secular bull market advance. As you're moving higher, many times you'll get this ABC pattern to unwind the overbought conditions, perhaps eliminate the negative divergence. That's what it appears to be doing to me. Now, these negative divergence, in all fairness to the bears, sometimes markets top with negative divergences like this. So what I look for is a 50-day test, and then we kind of start all over, just like a 3-game baseball series. You win the first game 10-6. You don't come out the second day with a 10-6 lead. You start over at 0-0. I look at the PPO very similar. Once we get to the zero line, or once we get a 50-day test and or a PPO centerline test, I view that as baseball game 0-0, where nobody's in charge. I mean, you give the advantage to the bulls because we're in a longer term uptrend. But as far as short-term momentum goes, it's wiped out at 0. Now, if you look at a weekly chart, you'll see that the PPO is very strong. So the long-term momentum is very, very strong. And here we could see a 20-week EMA test at any point. So look at all this. Look, during 2020, 2021, we had huge moves, PPO very strong, but we kept getting these 20-day tests, which held us all the way through the end of 2021. So, that from a long-term perspective, if you're somebody that says, I don't care what's happening this week or next week, I just want to look at the big picture. Well, I think this would be a good chart to look at. And I think as long as we continue to trend above that 20-week moving average, I would remain bullish. We trend below, we break below, I think I'd be looking at other signals, looking for corroboration. Did we see negative divergences at the top? Right now, no. We've got, at the top, the most recent high, we've got a higher PPO. That tells me that as we go up, the momentum is increasing. The bullish momentum is accelerating to the upside. That just simply tells me any pullback is buyable, especially if we get down to that 20-week moving average. Very similar to all these tests we saw, or even back here in 2019 before we hit the pandemic. Let's go on to the IWM, because the IWM is the one that I'm watching the closest. I actually filled out a position in the TNA, so I'm not going to be feeling very good at the open today. but I like the IWM pulling back to the 20-day moving average. And yesterday we actually put in a low below the recent lows, looked like we were breaking down. And then we ended up slightly higher on the IWM for the day, but it wasn't as high as some of the other areas, but it certainly felt a lot better than intraday. And if you look at that intraday 10-minute 5-day chart, you can see the selling early in the day and then right back up again. But our low yesterday was 192.68. And let's pull up the pre-market on the IWM, 191.94. Right now we're down 1.2%. So it's looking like we're going to open below yesterday's low, down in here somewhere. So this is, it's, again, it's the open, and we've seen plenty of poor opens over the last year and 3 months, year and a couple months. But normally we bounce back from that. Yesterday, really poor morning, we bounced back. We were down early in the morning on, that would have been on Friday. We bounced back, ended up going back down near the low. But here, morning low on last Thursday, last Wednesday, morning low, last Tuesday, morning low. So the pattern is that, and this again has been the pattern on the QQQ. I've talked about that countless times over the last 14 or 15 months. But the pattern on the IWM has been the most weaknesses in the morning, and then we rally. We'll see if that continues today. As far as that, the TNA position goes, I think that's going to be pretty important. We're going to need to see a rally. I do not want to see a breakdown below the 20-day and a close there, because that would start to point more toward maybe gap support test, price support test, 50-day test, and that would be from yesterday's close another, I don't know, $6, $7 lower. So something to watch today, certainly small caps. Transports moving up. The PPO is starting to flatten. It's rolled over, but it's rolled over with the weakness. I think the key is what kind of force do we have if we move back up one more time? If it's not a lot of force, we break out. You notice the volume's a little light, and that PPO is not responding to the push to the upside. It's probably going to be the final move to the upside, at least for the near term to intermediate term on transports. That's the way I read it now, but of course we'll look at it every day and kind of see where it goes from here. Let's move on to the chart of the day. Before I do that, take you over to earningsbeats.com. If you're not already a Earnings Beats Digest subscriber, it's a free newsletter. If you're not already a subscriber, you can scroll down at our website right there, name and email address, and we'll have you set up. Hit that subscribe button. We'll get you set up. Monday, Wednesday, and Friday is when we send out an email discussing the whatever that particular chart is that day. It may be an individual stock. It could be an industry group, a sector. It might be the major indices. It could be an intermarket relationship. I might be highlighting something with price volume. It could be candlesticks, relative strength. That's a big one. A lot of different things we talk about that we feel are really important and that you should certainly have a lot of knowledge about. That's what we discuss. Try to make it very educational, and it is free. No credit card required. You can unsubscribe at any time. It's simply a way for us to give back to the community. And again, so just go over to earningsbeats.com, scroll down. If you want to take out a trial subscription to our paid service, 30 days for free. You will have to provide us a credit card so we can get you set up in our system. But that is a 30-day, no-cost trial. Hit that button. We'll get you started. So what's the chart of the day today? Well, I wanted to show you a couple things here. So first, let's go back a few years on the medical equipment group, because this is a group that has not been performing very well. I mean, here we were at the beginning of 2023, and here we are now. I mean, we're barely, maybe we're up maybe 3 or 4%. That's what it looks like off the top of my head. So not very much considering how far the market has run, but money rotates. And I don't expect medical equipment to outperform semiconductors or internet or, automobiles or software. These are all groups that have been very strong when the secular bull market moves up. But money will rotate, and especially when you get into times like these where the market's consolidating, we're seeing a little weakness. Healthcare is one of the more defensive areas, although biotechs, I would say, are aggressive. Medical equipment, slightly aggressive. But I want to show you here the chart because I'm fairly bullish on this group right now, mostly because you can keep a very tight stop. I mean, if you go back to October of last year and connect the lows from there, connect the March low and the late May low, and then where we are right now, we're testing a really strong trend line. Maybe we go below it, but I would expect it to hold until it doesn't. So I think that's the first part of this chart that I think is really interesting. Now let me show you the 60-minute chart. So this is an hourly chart. So if you go back, what we're looking at now is just the last month. So this is the last month on a daily chart, but look at it on a monthly chart. This is where we got to the high late in July. Then we went on this downtrend. It's been horrible. No question about it. But notice at the last low, see how as we kept going lower, the hourly PPO kept going lower. So it was just telling us that, the bearish momentum was accelerating to the downside from an hourly perspective until we hit this latest low right here on Friday when we closed down at about the 25 area. Notice we had lower lows. Check out the PPO, hourly PPO. It turned and went back up. So we're starting to see that momentum slow to the downside on an hourly chart. And again, what I look for is a bounce to test the 50. So in this case, the 50-hour SMA, and a bounce up to the center line, which we've already started. We're on our way, but we've got to get through that 20-day. That's going to be the first test. And we could go back down to another low and still have another positive divergence. I mean, sometimes we have 3 lows, and sometimes they don't work. I mean, technical analysis is not perfect. I use it to manage risk. I don't use it for guarantees. So this is telling me that the odds of a little bit more significant bounce in this group, the odds are growing. No guarantee. The odds are growing. But I find it fascinating that the 60-minute positive divergence occurs simultaneously with this more intermediate term uptrend line being tested. So we've got slowing momentum in the short term. At the same time, we're hitting a major support area. This is a group that I'd be interested in following and potentially trading. Yesterday in the daily market report, I think I gave like 8 medical equipment stocks that folks could be looking at, either to buy now or maybe buy on any kind of any little bit further pullback. One I can show you that I think is interesting. I don't know if it'll pan out, but it is right at a support level. It was hit with earnings. Here we had the big top, came back down, set a low at 125, went all the way back in, put in a double top, and now we've come back down. It could be a double top and a breakdown, but I tend to look at things with rose-colored glasses on when I believe we're in a secular bull market advance, which I do. So I'm not looking for masses of stocks to break down. I'm looking for support to hold. So this is an area that I would probably be watching closely. If it doesn't hold 125, then 120 to 121 would be the major support level to watch. But this is an interesting area. I wouldn't be surprised to see Zimmer Biomet Holdings turn at this level. So, and that's how I kind of use technical analysis. Try to, look at the overall market, see what's going on, what's leading, what's not leading, areas that look like maybe they could be bottoming. And the thing about medical equipment is in this stock in particular, if it closes below 125, you get out. If this ends up holding and we go back to the highs, you're going to be up close to 20%. You don't have to give much, you don't have to take much risk on the downside. But again, having said that, with futures down, I don't know, maybe ZBH breaks down on the open. We'll have to see how this plays out. All right. I wanted to go over and just show you a couple charts here. One on this is the consumer price index. So on the top, you'll see over the last 5 years, This is just the CPI itself moving higher, core CPI. So this is the reading. So the last one we got was the June reading. We're waiting on the July reading, which comes out on Thursday morning. So always the end of the month reading comes out, usually during the second week of the following month. So June was the last one we got. And you can see the number here, that spread or that difference between these two wasn't as great. The percentage gain was not very much. And I want you to look at what's been going on now for the last 9 months on the annual rate. This is the annual rate of change of the core CPI. We're at 4.86. It's the lowest level we've had going back probably a year and 3 quarters. And if you come down here, this is just the 1 month rate of change. So we're expecting 0.2. If we come in at 0.2, it'll follow the June month, which was about 0.16. They always round it. It's always 0.1, 0.2, 0.3. But when you do the actual number and put it in the stock charts, it will give you the actual number, 0.16. So last month was 0.2, but technically it was 0.16, which was the lowest monthly reading we had seen in over 2 years. The monthly readings have been going down, down, down. And this is what a lot of folks are looking at the Fed and saying, why do you keep raising? Why do you keep raising? We're doing inflation is falling just like you wanted. But, and again, this is core, not headline. Headline number can fluctuate a little bit more. I like to stick with the core, which excludes food and energy. Those are and a lot of people say, well, why would you exclude food and energy? Those are the areas being hit the hardest. Well, it's because they can go up a ton. I mean, our inflation rate would be 30% one year and be minus 5% the next if we did it just based on food and energy. They're very, very volatile. I mean, energy can go up because of a geopolitical dispute. Has nothing to do with what's going on in the US. It's an outside influence. Food prices, we could have a bad summer, a drought that causes food prices to go up. Is that long-term inflation? No, it's a short-term volatile thing. I mean, I completely agree with the Fed. I think looking at the core level makes much more sense. That's going to tell us if we really have a systemic problem with inflation. And it was a problem back in 2020, 2021. Growth stocks got hammered because of it. Now it's been coming down the other way. We've seen growth stocks doing really well. I think this continues, but if we do have a spike, if we see 0.3 or even 0.4 on Thursday and or Friday, that I think could spook the market, especially during this time of the summer where we know the market doesn't do very well. So anyway, keep all that in mind looking at this chart. 2 other charts I want to show you, and then we're going to wrap this up. The first one I wanted to show you. So here's the 5-day moving average of the equity only put call ratio. So we got very bullish down here, and now we're rising. Now, I don't believe we're going to see any more. Well, I'm not going to say we're not going to see any more readings of 0.80, but it's very unlikely to see readings up there once you get into a secular bull market. We were coming out of the cyclical bear. It kind of hung around for a while. Notice these lows were broken as we started to accelerate in the market to the upside. Just like these lows were broken, I don't think these highs will be touched. So where might we top on this? I'm thinking 0.7 to 0.75. If things really, I mean, if we struggle over the next couple weeks and we see the market, go back down to 50-day moving averages, I could see this going up to 0.70, 0.75. And at that point, it'll probably mark a pretty significant bottom in the market. Right now, we're still rising. We're still showing an increased amount of pessimism in the options world, not really telling us a whole lot. But this one right here, when we hit these lows, normally these lows coincide with market tops. And you can see the one we had here was back in mid-July. Remember, we were saying how mid-July, I wrote article, I did some YouTube videos saying, hey, we got to be careful now. This is the time we've got to be careful. And since then, you can see it's been a struggle. So I'm not surprised by what's been going on here. But a little bit more bearishness in the short term. Maybe see that VIX. If that VIX got up to about 19 or 20, that would really start to tell me that we could look for a significant bottom. But we're not quite there in terms of the fear, not in terms of the volatility index or the equity only put call ratio. So I still think there's room potentially for more downside. I'd be mostly concerned with the NASDAQ and those large cap growth names. We've already seen Apple roll over, move below its 50-day moving average. I wouldn't be surprised if some others follow suit a little bit. We're past the news. So it's always, buy on rumors, sell on news. Well, we're past the news. So I think the selling kind of fits into that story as well. Let's see, what else did we have here? I wanted to show you, I will show you that the 253-day moving average of the equity only put call ratio. And this is when people say, well, everything's getting complacent. So could this be a long-term top? Well, this chart right here says no. We've already gone and had tremendous fear in the market. I believe, have set a major top in the 253-day moving average of the equity only put call ratio. This is rolling over. History tells me when this starts to roll over, the market goes higher. Doesn't mean the market goes higher every day. Doesn't mean the market doesn't have pullbacks, even corrections. But the overall trend, in my opinion, is up in the market. And I think sentiment plays a big, big part in this. What else did I have? I wanted to show you the QQQ and the spider. I actually updated this morning. So if we include gaps right now, this is an intraday analysis. Well, the top part ignores gaps, bottom part includes gaps. But this is what the QQQ versus the spider is doing. So you can see that the QQQ in mid-July topped relative to the spider. So the NASDAQ, the more growth-oriented names on the NASDAQ topped relative to the more value-oriented names on the spiders, S&P 500. And you still have growth names on that, but not the weighting isn't the same. There's more weighting in the spider toward value, much more weighting toward growth in the NASDAQ. So here we topped. So what this is telling me is that we're seeing a little bit of rotation away from the QQQ into the spider, and we've had a huge run. So I think that pullback away from it, I think, could continue for a while. But if we strip out the gaps, ignore the gaps, because to me, that's a lot of it is manipulation. I mean, seriously, what happened between yesterday at 4 o'clock and today at 9:30? And we saw this for months on the QQQ, where we were getting gap downs, morning weakness, and then buying. I showed you the IWM last 5 days. Much of the weakness, if we're going to get it, tends to be in the morning. We haven't had many big afternoon sell-offs in the IWM. So ignoring the gaps and just looking at intraday movement, what is going on during the day? Are we seeing money rotate into value or growth? Are we seeing it into the NASDAQ, the S&P? Is it into consumer discretionary, consumer staples? These are some of the things that I think are really important, just to kind of get a sense of what truly is going on in the market, rather than just, the market's, the Dow's down 231 points, and now we're under pressure from Moody's downgrade. These downgrades, I'm not going to say that they're not important, but, it was, I think it was Warren Buffett just came out a few days ago and said basically the same thing. These downgrades don't really mean much. It's clickbait. It's negative news the media can focus on for a little while. Remember, you've got your informants from or the informers from the big Wall Street firms. They go on CNBC and tell you the sky's falling and this is horrible. I mean, how long did the Morgan Stanley guy, Wilson, how long was he bearish? And now he's finally come around and said, hey, I got it wrong. Now, you know, we've seen the move to the upside. We're getting a little bit of a pullback. The market was due for a pullback. I said it 3 weeks ago, mid-July. I did videos, I wrote articles. The market was due for a pullback. We had things to be worried about in the near term. But as soon as we start selling off and then we start, you know, seeing a few days of weakness, then everybody's back on the bear, you know, that bear bandwagon. It's going to take a little bit more for me. All right. That's about it. I tell you what, it is past 9:30. Actually, we're 5 or 6 minutes past. Let me go ahead and give you a quick update. So we got the Dow down 287, NASDAQ down 108. So down about 0.7 to 0.8% on those three major indices there. Small caps, though, definitely getting hit harder here today. The VIX back up to 17. It's up 7%. Let's take a quick look at that VIX. Because I do think there's an outside chance here. I mean, we've now been hovering above the recent highs. I think there's a chance if we have selling today, this could start to make a run for 20. But we have a lot of tops at 20. I don't think we're going to close above 20. That's my personal feeling. But, and I said this a while back, if we saw weakness throughout August and September, I thought that the VIX could get back up to around 19, 20. And so I still think that's possible. I think the market is kind of edgy, obviously, right now. And we'll just have to see how things play out. If, we get another afternoon recovery, then, maybe this starts to subside. But I think the thing that would really spook the market is to get a little bit more during the day selling. And then also watch those two reports coming up Thursday and Friday. The CPI and the PPI. I personally like to watch the CPI. I think that's probably a little bit better gauge of inflation rather than the PPI. Sometimes PPI jumps and it never gets passed on to the consumer. So I think it's really important to see whether it's actually being passed on to the consumer. So watch that CPI report on Thursday. I think if it's plus 0.2 or lower, I think we get another rally, ahead of the Fed meeting later this month. But we'll see. I was just thinking about one other thing I wanted to show, and now I've forgotten. Anyway, I'll talk about it tomorrow if need be. Anyway, listen, have a great day. Let's see what the market does the rest of the trading day, and then we'll go from there. Happy trading, everybody.